This is how we thought it will be for the deep buying. However, the reality of dollar cost averaging could be like this instead. From our previous sector analysis, technology sector is at the dip. Thus, I will focus on the stocks in the technology that is still undervalued. In this case, let me use Microsoft as an example. Open the same chart for the Microsoft. This is the daily chart. Here, I will mark the estimated intrinsic value of Microsoft, a blue dotted line at around $290. It is pretty clear that the current price is undervalued. Therefore, any price below $290 and near to moving average is a good buying point to me. Do you notice that Microsoft tends to rebound at moving average 50? Thus, to me, $244 is a nice entry point. Indeed, I added some Microsoft shares around that level. Next, if we look on the weekly chart, next dip at $220, $187, and $181 will be next buying points. We do not know if Microsoft will reach these levels, but we could also keep some cash on hand. I will elaborate more on this in the next step. On the other hand, if you look on the cost call, you may notice that the current price is also below its intrinsic value, $426. However, the current price is far from the current SMA 20. Thus, to me, I will not buy the stock even though it is still undervalued. I will patiently wait for the dip. For the other technology stocks such as Apple, similar to Microsoft, it also dips to MA 50. However, I still prefer to add Microsoft as its current price is only 4% undervalued. Compared to Microsoft, that is 13% undervalued. Microsoft is more attractive to me. There are two important points to note for this strategy. First, the company must be able to make consistent profit for the past 5 to 10 years. This is to ensure that the company has the ability to keep increasing its valuation to support its trend. A company that is undervalued because of its fundamental issue, it will remain undervalued or even more undervalued, price decline because of keep producing the results with bad performance. If we dollar average this kind of company, we will lose more money instead of compounding our wealth. Some companies, such as Apple, tends to trade above their intrinsic value. Investors are willing to pay a premium to hold a good company like this. Thus, if you are confident to the company, you still can purchase their share as they can easily justify their high valuation with their earning. However, please be reminded that the higher interest rate will still give some pressure to the stocks with higher valuation to their intrinsic value. Step 3. Staggered bullets, keep cash and never use margin. Step 1 and Step 2 sounds easy, right? Identify a good stock, then just buy at each dip. This approach is also called dollar cost averaging. This is how we thought it will be for the deep buying. However, the reality of dollar cost averaging could be like this instead. The moment it reaches the real bottom, most of us may already use out our bullets and suffer a huge loss. Although in long run, we could still be profitable after the rebound, but it will also cost us time opportunity as it may take us very long time for the stock to move above our average price. During this period, it won't be feeling good to see our account in red. Some investors may lose their patience and close their position at a loss, which is then rebound and regret after that. Therefore, this step 3 is more on emotional control. When I buy a dip, I will always ensure I keep a portion of cash and I only buy the dip at the critical support. Let me use Costco as an example. This is a daily chart for Costco. In December last year, I added Costco at around $370 when it dips to moving average 50. This is because previously, MA50 seems to be a nice support for Costco. Instead of using all my cash, I only use around 10 to 15% of my cash to add the position. However, it further dipped to MA100 around $363. Do you notice that $370 and $363 are quite close to each other? Thus, I did not add any position there. Instead, Now I use weekly chart to check the next buying opportunity. From the weekly chart, it is clearer that MA50 at $331 in February was also a buying point. Here, $331 is around 10.5% lower than my first purchase price of $370. I added shares here with another 15 to 20% cash. Because of this, it saved my bullet in between $370 and $331. Next buying opportunity was at $305. When it dipped to moving average 100, it is around 8% from the moving average 50. However, at that period, I already used quite a number of cash to purchase technology stock such as Microsoft, Google. I do not have enough cash to buy at that level. After that, Costco rebounds nicely from moving average 100 and now is testing its all-time high. Hope you get the idea on how I did the dollar cost averaging. I only purchased the dip at each critical support and always keep a portion of cash on hand. In general, I will keep around 20 to 25% cash on hand. As I'm doing monthly deposit to my account, I'm fine to have my cash proportion as low as 5%, as my monthly deposit will increase the cash percentage again. However, for those who have limited cash, my suggestion is to sell part of the shares when it reaches the high again. I hope this video could help you to understand how I react with the market and identify my buying points. In summary, now I will only focus on the big cap profitable companies undervalued based on their discounted cash flow and ETF. I will still buy the dips whenever it reaches my buying point. What is the stock in your watch list in May? Share with us in the comment below. Before you go, please give me a like and subscribe my channel if you have not done so. In the next video, I shall give an update on the stocks on my Momo account. See you in the next video.